there are things that happen that are going on right now that don't make sense. And we're going to get to it, because what we've seen this week is something that we've never seen before. I think we mentioned last week a term that many people probably haven't heard of yet, which is backwardation. And to kind of just put it in a nutshell, and then you can definitely, because you know a lot more about it, discuss what backwardation is. Basically, when the spot price or the cash price for any metal exceeds the futures price, that is what we call backwardation. And this time alone, the COMEX joined the London market, where the silver price structure has been in backwardation for the recent weeks. And when we have sufficient physical metals available in the market, the cash price or the spot price for immediate delivery is typically lower than the futures price, maybe by about typically 20, 30, 40 cents around there.
At least.
That's around that.
But it's the cash value of money. The further out you go, it's like lending someone money. If you lend someone money and they're going to pay you back immediately, there's not much of a vig. If you lend someone money and you're going to take it in 6 months, you should have to pay more.
Correct.
Right?
And when the spot price, what we've seen now, surges above the futures price, it's an indication that there's urgency in the market to source that metal for immediate delivery.
Right. The normal structure is called contango. And contango is when futures trade above spot, which reflects the cost of storage, reflects the cost of financing and insurance. And we are far from contango right now. We are, as you mentioned, in the biggest backwardation I've ever seen. It signals urgent demand. It signals depleted inventories. It signals a systemic shortage of deliverable bars. Give me my bars now. I don't want to take your promises into the future.
This is one of the things that I wanted to go over that you might say that, well, you might not be proud of me, who knows? But one of the things that I had researched when we were starting to look at the backwardation was in May of 21, the LBMA admitted that they overstated the London Vault holdings of silver by about 106 million ounces.
Yeah, well, they only have a free float right now of 140 million. So what does that tell you?
Well, around the same time, SLV silver holdings, especially in London, it spiked significantly when a lot of people, and David Jensen, give him the quotes on it, noted it. And he had actually said that let me just bring up his quote. He said, quote, "The demand for silver may temporarily exceed available supply that is acceptable for delivery to the trust. Authorized participants may be unable to acquire sufficient silver that is acceptable for delivery to the trust due to a limited then available supply coupled with a surge in demand for the shares."
You know when that happened? That happened actually in February of 21 during the silver squeeze. So much silver piled into, or so many people bought shares that they, over the weekend, State Street, which is BlackRock, changed the prospectus to basically say, yeah, there might be more demand than there is silver in the trust.
Well, our infamous leader just brought exactly what we're talking about. The question is, was the LBMA's 100 million ounce overstatement related to the 100 million ounce temporary spike in SLV's London Vault holdings?
Probably, and it was did
BlackRock issue SLV shares without actually buying
it's the numbskull that used to work for Goldman Sachs. His name was I forget his name, but he said that that the banks are the shorts, that they take the money or the metal that goes into SLV and they short it, which they should never do because it's a proxy. You would not short metal because the metal is supposed to be 1-to-1 for the shares. And if you're shorting the metal inside of SLV to drive down the price, you're in essence borrowing people's shares without their permission.
Correct. So that's listen, my take is it's a little bit more than coincidence. I don't think it's the alcohol talking.
No, not yet. Let me finish this drink. Yeah, it might be, but the delivery strain is extraordinary. In October alone, we've seen almost 15 million ounces that have been delivered into COMEX. And when you have a $3 spread between New York futures and the physical market, there's a big problem. There's a huge problem. Not only that, the borrowing costs. Normally, the lease rates are about 0.5%. Right now, they've gone up to 100% annualized. That's worse than any time in the history of the market.
I think you should delve in a little bit more on explaining how the lease rates work.
So if you're going to short something that you don't have, you have to borrow metal to sell. Or if you have to cover something with metal you don't have, normally you could lease it very inexpensively. Now you have to lease it at 100% annualized cost. It's putting massive squeezes upon the big banks, but look at it from companies like ours, okay? So if I buy 100,000 ounces over the counter, spot, right? If I buy 100,000 ounces, the only way I can hedge it is with the New York futures, with the COMEX contract. But if the COMEX contract is $3 back a spot, how does that work? It doesn't work. I'm hedging something $3 lower than what I have to pay for it in terms of over the counter. In other words, the futures are way lower than the physical. So I pay this physical for $10, but I can only hedge it at $7. That's a problem.
There are things happening right now in the silver market that flat out don't make sense. I've been doing this for over 3 decades, and I can tell you, I've never seen conditions like these before. We're not just seeing price volatility, we're seeing the fabric of the market start to tear. This isn't just another upcycle or a short squeeze, this is structural, and it's playing out in real time while the mainstream financial media pretends not to notice. Let's start with a word most people have never even heard before. Backwardation. Sounds technical, I know, but it's actually pretty simple and incredibly important. In a normal market, you've got what's called contango. That's when the futures price of a commodity trades above the spot price, meaning the price for immediate delivery is lower than the price for delivery in the future. Makes sense, right? There are costs to storing and insuring metal, and there's the time value of money. So if I sell you silver for delivery 6 months from now, you should pay a little more for that convenience. But backwardation? That's when the world flips upside down. It's when the spot, or cash, price for metal exceeds the futures price. And right now, that's exactly what's happening. Not just in London, but on the COMEX in New York. The biggest backwardation I've ever seen. And that's not normal. It's not just tightness. It's an alarm bell. Backwardation signals one thing above all else: urgent demand for immediate delivery. It means the market doesn't trust paper promises anymore. It's saying, I don't want your future contract. I want my bars now. That's not how a healthy market behaves. In normal times, it's cheaper and easier to hold futures. But when people are paying more to get the metal right now, it means the system's running out of deliverable supply. To put numbers on it, typically you'd see a 20 or 30 cent gap between spot and futures. Maybe 40 cents in a tight market. But what we're seeing now is dollars. $3 spreads between the New York futures and the physical market. That's not just unusual, it's historic. It's the kind of distortion that only happens when inventories are exhausted and the physical market has gone rogue. Now, I don't care how many talking heads on CNBC claim the market's well supplied. They said the same thing in 2021, right before the silver squeeze, remember? The London Bullion Market Association, the LBMA, even admitted after some pressure that they overstated their vault holdings by 106 million ounces. Oops, that's not a rounding error. That's a lie, and the timing couldn't have been more suspicious. Around that same time, SLV, that's the big silver ETF managed by BlackRock, reported a sudden spike in its London vault holdings by, you guessed it, about 100 million ounces. Coincidence? Come on, it's like the old joke. 2 guys leave a bar and both their wallets are missing, and one says, "Funny, must have been the wind." This wasn't wind. This was a swap, an accounting trick to paper over a shortage. And when people pointed it out, what did SLV do? They quietly changed their prospectus. They added a little disclaimer that said essentially, hey, there might be more demand for silver than we can actually get. In that case, we might not be able to deliver. In plain English, we might not actually have all the silver we claim. Let that sink in. The biggest silver fund in the world, backed by trillion-dollar institutions, literally admitted there might not be enough physical metal to meet demand. That was during the 2021 silver squeeze, when retail investors on Reddit tried to expose the manipulation. They were right. They just underestimated how far the system would go to suppress the truth. Fast forward to today, and we're seeing that same stress return, only worse. The London vaults have been steadily draining for years. According to the LBMA's own data, there's roughly 800 million ounces of silver left in London. But only a fraction of that, around 140 million ounces, is free float, meaning available for delivery. The rest is spoken for by industrial users, ETFs, and sovereign holders. So effectively, The world's most important silver hub has maybe a few months' worth of freely available metal left. And meanwhile, demand's exploding. India's been importing silver hand over fist. Solar panel manufacturers are hoarding it. Retail bar and coin premiums are at record highs. Central banks aren't buying silver directly, not yet, but they're cornering gold. And that puts even more pressure on silver as the monetary cousin.
One of the things that we really should talk about, because as much as metals have moved, one of the things that has happened is there has become an enormous spread between the bid side of silver and the ask side of silver.
I just talked about that.
So, but explain to it, because if somebody calls us in today or tomorrow and says, Andy, I want to sell 2,500 ounce bars, and we give them a number, we have to go off the bid side of spot. And that's going to be a bit strange when they're seeing it trading.
Right.
So explain it a little bit for us.
Well, let me read something to you. My dear friend Michelle McCory just sent me, because I think it's important to understand. She sent me this. This is from the Perth Mint. I can't validate it, but Michelle is a pretty smart gal and said this is what she just heard. Perth Mint suspends silver sales amid global shortage. Australia's Perth Mint has halted all silver product sales due to overwhelming demand and supply chain issues, while U.S. dealer commercial rare coins and precious metals has frozen transactions as of October 13th, 2025. The shortage stems from industrial demand in solar panels, electronics, and EVs, outpacing mine production by hundreds of millions of ounces annually, driving spot prices above 50. That's not the reason, but that's part of it. Per ounce, and record premiums on physical bars. Experts highlight plummeting London vault inventories and refining capacity strains as key factors fueling potential further price increases. So the bottom line is simply this. Again, if I buy back metal from people, I have to hedge it. If we have 1 million ounces of silver in our warehouse and the price goes down by $1, we're dead. We lost $1 million. So we have to hedge it. But if able to hedge it with contracts, it's $3 back. What do? We have no choice. And if you look around, you'll see this is not just Miles Franklin. This is every company in America. Everyone's freaking out. Half the companies aren't even taking orders. Our supplier, one of our suppliers this morning,
called us. Yeah,
he sent an email saying that
we're
halting all trading until we get a handle on the premiums, on the availability, and on the spread.
Reading that refiners are pushing retailers to buy back junk metal and sterling at 50% back to spot. Andy, what are you hearing? That's definitely not true.
Not true.
I think our buyback right now on junk, I think Josh just did the rewrite. I think we're probably around 350 back, somewhere around there. So about 350 back a spot, which is extremely competitive. It might be even a little bit better than that. I don't even know. But no, it's definitely not 50%. That's for sure. All right. And then we want to go to Earn Dog B. If someone were to have 1,000 ounce bars, would this be a good time to move them into small denomination bars? So because this being huge demand and get the same amount of silver back.
If he did it into junk silver, he could probably.
No doubt. Junk silver, no matter what, even still right now. And premiums, trust me, are definitely on the rise. When we got our wholesale numbers from the large wholesalers and distributors today, Silver Eagles have shot up enormously in premium. You will find that right now, most dealers out there are probably going to be close to about $8 over spot for Silver Eagle, roughly around there. So junk silver, you can still get very, very inexpensively relative to the overall market. So definitely something to look at.
I'd also like to say people have probably read the Bloomberg article that's talking about the shipping of metal back to London. I think it's all bullshit. There's a little bit. You got traders taking advantage of that spread, but it's a cover story as far as I'm concerned to calm the nerves of the market. If supply were fine, they wouldn't need a PR rush in order to say everything is fine, is moving back there. The physical supply just isn't there. And you can't move enough metal across the Atlantic in a fast enough time to meet urgent delivery needs, which means you're getting margin stress. People are getting margin calls and they have to deliver or do something, and it's hitting the paper market. And this means leveraged players are under severe pressure, real pressure. And this is, I guess, a hallmark of illiquidity and forced liquidations.
Let's keep going because this is where things get wild. The silver market today isn't just tight, it's broken. And the signs are everywhere if you know where to look. Start with the COMEX, the heartbeat of the paper silver market. For decades, this exchange has been where the price of silver is discovered. But that price discovery mechanism depends on a critical assumption: that futures contracts can be converted into physical metal whenever someone demands delivery. That assumption is now being tested, and it's failing. When you see backwardation this deep, when spot trades above futures for weeks on end, it means one thing. The market doesn't believe those future contracts will be honored with metal. They might be settled in cash, but not in bars. And that realization is contagious. Once one institution decides to take delivery just to be safe, others follow. It's the same psychology as a bank run, and the data confirms it. Deliveries on the COMEX have surged. In the past 6 months, we've seen over 60 million ounces stand for delivery. A record. That's not hedge funds playing games. That's industrial users, sovereign entities, and big private investors saying, ship it. Meanwhile, inventories in registered vaults, the metal available for delivery, have plunged to multi-year lows. JP Morgan's vaults, for instance, are down more than 70% from their 2020 levels. At this point, we're looking at roughly 30 million ounces left that are truly available for delivery. That's 1 month's worth of global solar panel demand. So what happens when the next batch of contracts comes due and too many people demand delivery at once? The exchange either defaults or settles in cash. And if that happens, game over. The price of silver will detach from paper entirely. Now let's talk about lease rates again, because this is the tell that even the mainstream can't ignore. At 100% annualized, lease rates are screaming that there's no metal to borrow. Banks that used to finance short positions for a fraction of a percent are now being told, sorry, if you want ounces, it'll cost you your soul. That's why we're seeing panic in the bullion banks. They're trapped. For years, they've run massive synthetic short positions to suppress the price and protect the illusion of stability. But now they can't find metal to roll those positions. They're caught in their own web. And this isn't just theory. You can see it in the charts. Every time silver spikes, the banks dump paper shorts to slam it back down, but the dips are getting shallower and the rebounds are faster. That's the market telling you the suppression's losing power. You can't paper over a physical shortage forever. Eventually, reality wins. Now let's zoom out a little. Why is this happening now? Part of it is industrial. Silver isn't just a monetary metal, it's a critical industrial one. It's in everything. Solar panels, electric vehicles, 5G, semiconductors. Global solar demand alone is projected to exceed 200 million ounces this year. That's almost 1/5 of total mine supply. And mine supply, by the way, is declining. The big primary silver mines are depleting, and new discoveries are rare. You can't turn on a new mine overnight. It takes a decade. Meanwhile, investment demand's surging. Central banks are buying gold hand over fist, and silver always follows gold. ETFs, sovereign funds, and even retail investors are moving into physical. Combine that with industrial consumption, and you've got a perfect storm: soaring demand, shrinking supply, and collapsing inventories. That's why we're seeing this once-in-a-lifetime backwardation. It's not a fluke. It's the logical outcome of years of paper manipulation meeting hard physical limits. Now here's where things get really interesting. Remember how I mentioned the LBMA's 106 million ounce overstatement back in 2021? That wasn't a one-off. It was a warning shot. They got caught padding the numbers, and instead of fixing the problem, they just got better at hiding it. But you can't fake inventory forever. At some point, the bars have to show up, or they don't. And the more these exchanges rely on smoke and mirrors, the closer we get to a confidence crisis. When that happens, the whole pricing mechanism for precious metals breaks. You can't have a futures market setting prices for a commodity nobody's willing to deliver. It's like pricing food in a famine using restaurant menus. That's why I believe we're on the verge of a reset in the way silver and gold are valued. We're already seeing it in the premiums. Retail buyers are paying $5, $8, $10 over spot, and they're still buying. That's not normal investor behavior. That's fear. That's people front-running the next leg of the crisis. And make no mistake, this is a crisis. When physical markets go no offer, the paper system implodes. We saw shades of this in nickel on the London Metal Exchange in 2022, when prices shot up 250% in 2 days and the LME canceled trades to save the banks. That same dynamic's now brewing in silver. The difference is silver's monetary. It's not just another industrial commodity. When this market blows, it's going to shake the entire financial system. And let's not forget, silver isn't alone. Gold's in backwardation too, though not as extreme. The entire precious metals complex is signaling stress. Central banks are draining supply at record pace. The East's hoarding what the West's selling. China's quietly importing record tonnage, while Western investors chase tech stocks and meme coins. It's the greatest wealth transfer in modern history, hiding in plain sight. When this all unravels, you'll see a bifurcation. Two prices for silver, the paper price and the real price. The paper price might say $35, but try finding a dealer who'll sell you an ounce for less than $50. That's the moment the illusion ends. That's when people realize the price was never real to begin with. So where does this go from here? I think we're heading into the phase where silver decouples entirely from the COMEX. Physical buyers will start setting the real market price, just like in the oil market when physical barrels traded at massive premiums over futures. It'll be the Wild West for a while, but eventually a new system will emerge, one that values silver and gold for what they truly are: money. I know that sounds dramatic, but think about it. We're living through the unraveling of a 50-year experiment, the fiat standard that began when Nixon closed the gold window in 1971. That experiment is failing. The dollar's purchasing power is collapsing. Global trust in U.S. credit is eroding, and the metals, real money, are reclaiming their role. We're seeing history rhyme. The same signs that preceded the 1980 silver blow-off and the 2011 rally are flashing now. Only this time, it's on a bigger scale. So, what do you do about it? You prepare. You get your physical metal while you still can. You don't wait for CNBC to tell you it's safe. By then, it'll be too late. You treat silver and gold not as investments, but as insurance. Insurance against the insanity of a system built on promises that can't be kept. Because when this bubble of paper promises pops, and it will, the only thing left standing will be what's real. And in the end, that's what this whole story's about. Trust. Trust in markets, trust in money, trust in truth. Right now, that trust is breaking. And when the dust settles, the people holding real silver and real gold won't just be rich, they'll be free.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.